The death toll from the virus rises.
With pneumonia-like symptoms.
Human-to-human transmission.
Very serious public health threat. The number of known infections has risen sharply. 4,500 cases.
The year was 2021. Vietnam faced a sudden shock. Not a financial crisis, but a total economic standstill. Tens of thousands of businesses disappeared and GDP growth came to a halt. But Vietnam refused to accept defeat. The country didn't aim to just recover, it aimed to accelerate, make up for the lost time. The pressure landed on one key institution, the State Bank of Vietnam. The SBV confronted a tough choice. Should it flood the economy with cheap money to ignite growth at any cost? Or should it protect long-term stability, even if it meant slow recovery? This was the high-stake dilemma between quick gains and lasting survival.
Aggregate demand, aggregate supply model, as developed by Mercury in 2018, illustrates the trade-off faced by the State Bank of Vietnam is balancing growth and maintaining price stability in the post-COVID period. ADAS framework explains how fluctuation in aggregate demand and supply determine the national output and the overall price level in both the short run and long run. According to market, the aggregate demand curve shows an interdependent relationship between the price level and output. When the State Bank of Vietnam lowered interest rate and increased the money supply to stimulate lending and spending, aggregate demand shifted to the right. In the short run, it leads to a rise in production and employment, reflecting that a monetary policy can temporarily boost economic growth. However, this temporary boost comes at a cost of rising price. The inflation rate increased accordingly. This highlights the crucial trade-off. The short-run aggregate supply curve is upward sloping because risk and price adjust slowly. As aggregate demand rises, firms increase production, pushing GDP above its potential level. However, over time, expectations adjust and wage increase, shifting the short-run aggregate supply curve upward. Consequently, the economy returns to its long-run equilibrium output at a higher price level. The process illustrates that a monetary expansion has no long-term effect on real output. It only determines the inflation rate and merely changes price. Here is a figure illustrating the short-run and long-run aggregate supply curve within the ADAS framework. Making link the framework to the Phillips curve, which captures the short-run trade-off between inflation and unemployment. Lower interest rate and higher demand reduce unemployment but increase inflation. In the long run, however, the Phillips curve becomes vertical at the natural rate of unemployment, meaning there is no permanent trade-off between inflation and output.
Following the global lockdown, Vietnam emerged with a post-pandemic war. From 2022 to 2025, the SBV executed a highly flexible, two-phase economic maneuver, a true Vietnam gambit, to first stabilize, then supercharge its economy. The year 2022 marked the peak of recovery. Driven by a surge in exports at the end of lockdowns, GDP rocketed to a record high 8.02%, significantly outperforming its Asian neighbors. But this success met a global headwind: aggressive U.S. Federal Reserve's interest rate hikes. To stabilize the Vietnam dong and control inflation, the SBV responded decisively with monetary tightening. They simultaneously raised policy rates by 200 basis points and sold an estimate of 20 to 25 billion in foreign reserves. The result? Inflation was expertly contained at just 3.15%. As the global economy slowed in 2023, Vietnam's GDP growth decelerated to 5.05%. The SBV executed a strategic reversal. They cut policy rates 4 times, shifting the focus from fighting inflation to rescuing growth. The goal was clear: lower the cost of capital, boost credit, and keep the economic engine running. In 2024, the strategic easing paid off. 2024 saw a recovery, with GDP hitting 6.1%, fueled by the rebound in exports and increased public investment. Inflation remained well controlled. The SPV maintained its growth-supported stance, keeping the policy rate low and pushing capital access through preferential packages like the 120 trillion Vietnam Dong initiatives to sustain the momentum. Looking into 2025, with preliminary GDP projected at 6.5%, the GDP is shifting toward a risk-conscious approach. While low rates are maintained, the SPV is flexing its muscles with indirect tools like T-bills to manage liquidity and prevent asset bubbles. The core focus is now on the quality and the efficiency of capital flows rather than just the total amount of credit. Vietnam's growth, primarily driven by robust exports and foreign direct investments, continue to be a regional bright spot, exceeding the ASEAN average. The SPV's journey from aggressive tightening to decisive easing demonstrate a remarkable, flexible strategy in balancing high growth with rock-solid macroeconomic stability. The Vietnam Gambit is proving to be a winning strategy.
To understand Vietnam's post-COVID monetary stances, perhaps we should look outward. Many countries outside of our country have also faced the same inflation, growth, trade-off like Vietnam, and their experiences could prove to be valuable lessons for Vietnam. Indonesia, for instance, prioritized stabilizing prices early. Bank Indonesia set inflation targets at 3%, 3%, and 2.5% for 2022 to 2024. When inflation rose above that in 2022, Bank Indonesia raised their policy rates, containing inflation within that range. Growth slowed, true, but stayed stable. This shows that restoring price stability takes precedence over growth. In Southeast Asia, the Philippines also followed a similar path. The BSP extended its 2 to 4% inflation target from 2024 to 2028 and kept interest rates elevated while inflation stayed above target. Only when inflation fell to 2.9% in early 2025 did the BSP begin reducing rates, gradually strengthening credibility in inflation expectations. Thailand, on the other hand, opted for a balanced tightening strategy. The Bank of Thailand kept its key rate steady to preserve policy space for medium-term risks, then later made a cautious cut from 1.75 to 1.5% in policy rates. This approach supported activity while still preventing a loss of inflation control. The United States, too, emphasized price stability above all. The Federal Reserve stated that inflation remained above the United States' 2% inflation target and maintained policy rates at 4.25 to 4.5% in 2025 to combat this. This highlights the importance of anchoring expectations and preserving policy buffers before easing out with the policy rates. These international experiences show that Vietnam must coordinate fiscal and monetary policies, and we also must ensure disciplined public spending alongside credit expansion and prioritize inflation control above all else, over aggressive growth measures. Maintaining policy space and reserves will strengthen the resilience and support long-term sustainable growth.
Now, let's move to the critical evaluation of the SPV monetary policy. In the early phase, the SPV prioritized economic revitalization after COVID-19. In 2022, the bank maintained an expansionary monetary policy and implemented interest rate support program, showing an impressive recovery in the domestic demand, with total retail sales of goods and services increasing nearly 20% over the previous year, which was much higher than the pre-pandemic average. This improves the effectiveness of the monetary transmission channel, encouraging investment and consumption. Consequently, the aggregate demand shifts to the right, supporting the businesses to function efficiently, especially in the export sector. However, the prolonged accommodative policy also created several macroeconomic risks, especially from 2023 to 2024. The inflationary pressure stemmed not from domestic demand pull factors, but from cost push and imported factors. The higher global oil price and exchange rate volatility contributes to higher Vietnam's CPI, especially in the context of rising global inflation. Moreover, there would be some chance that an extended period of low interest rate might pose risk of asset bubbles and financial stability problems. This situation illustrates the trade-off between short-term growth and long-term stability. The SBV accepted higher inflation risk to support recovery in the initial phase, reflected in the unemployment rate falling to 2.28% and the labor productivity rising by 3.65% in 2023. However, if the accommodative policy was prolonged, it may cause the persistently high inflation, making future stabilization more costly and undermining public trust. Therefore, the policymakers must weigh the trade-off. If the inflation is temporary and cost-push, supporting growth is reasonable. But if the inflation stems from expectations or weak transmission, price stability must take priority. The effectiveness of SBV monetary policy was limited due to weak coordination with the fiscal policy. By September 2024, the public investment disbursement remained sluggish, reaching only 47.3% of the yearly target, which is lower than the rate recorded last year. This reduced the fiscal policy support and placed the pressure on the monetary policy. Moreover, despite the low interest rate policy, manufacturers still struggle to access credit, thereby diminishing the impact of monetary easing. Consequently, strengthening the monetary and fiscal policy frameworks is essential to ensure stability.
Government policies in 2024 and 2025 did stimulate growth, but that growth came with a cost, rising dependence on credit and higher inflation risk in the years ahead. Global commodity prices are unexpected. Credit-driven expansion is fragile, and even though today inflation looks low, the risks are already forming beneath the surface. State Bank of Vietnam still has policy space, and it must use that space to stabilize prices before chasing short-term growth. And to avoid overheating the economy, the State Bank of Vietnam cannot act alone. It needs tight coordination with the Ministry of Finance because fiscal tools like public investment and tax cuts stimulate growth with less inflationary pressure compared to broad credit fuel expansion. And the Ministry Operation of Finance accelerates public investment so that State Bank of Vietnam can finally normalize credit growth and manage systemic risk. This is how stability is built, and the market react not just to policies, but how too predictable those policies are. And the State Bank of Vietnam must clarify its policy goals, how it responds to exchange rate pressure, and how and why credit limits change, so that clear signal can come to stronger market confidence and more effective policies. Develop the domestic financial market. Vietnam cannot depend forever on bank credit. It creates bubble, bad debts, and suffocates long-term resilience. So what's the solution? A deeper, more liquid corporate bond market and a stronger stock market. Diversifying capital sources isn't optional. It's the foundation of sustainable growth for the next decade. Short-term stimulus helps, but sustainable development requires discipline. It needs inflation control, transparency, fiscal monetary harmony, and a financial market that can stand on its own. Vietnam's post-pandemic experience shows one clear truth. Recovering fast is important, but staying stable is essential. As global conditions shifted, the risks started to build. Imported inflation, exchange rate pressure, and asset market tensions. Growth became more fragile. So what's the way forward? Vietnam needs strong coordination between monetary and fiscal authorities. At the same time, the State Bank of Vietnam must prioritize price stability Because if Vietnam can balance stability and steady growth, it won't just recover, it will build a more resilient, more balanced, and more sustainable future.